i.e., using EVA as a performance evaluation method, determine whether the manager of the biscuit division created value in the current financial year. All right, so obviously before we can determine whether he created value in the current financial year, we are going to have to calculate EVA. If we have a positive EVA, it means value was created. If we have a negative EVA, it means value was destroyed. So I recommend you start by writing out the formula first, because once we have the formula, you'll then know what other calculations are necessary. Alright, so we calculate EVA by taking the adjusted net operating profit after tax and deducting the adjusted capital employed multiplied by the divisional WACC. So the first calculation that we are going to look at is adjusted net operating profit after tax. Alright, so before we look at the adjustments, let's first calculate net operating profit after tax. Once we have net operating profit after tax, we can then look at the various adjustments that need to be made. So, if we go back to the information provided in the scenario, first we were given total expenses, and in note 1 you were told what those total expenses include. Then after that you were given the operating profit margin, which is 30%, and that is excluding allocated head office costs. You were also given non-current assets at book value, non-current liabilities, current assets, and current liabilities. Now, this information over here is going to be used to calculate the adjusted capital employed. We're obviously not going to look at that when we are looking at the net operating profit after tax. So we'll come back to that information a little bit later. For now, we need net operating profit after tax. Now, you haven't been given operating profit. However, we can work backwards to calculate operating profit because you have been given the operating profit margin. How would operating profit be calculated? We would calculate operating profit by taking sales, deducting operating expenses, and that would leave us with operating profit. So if we look at the maths logic over here, sales would be 100%. We know that the operating profit margin is 30%, so that means operating expenses must be 70%. So we need to calculate operating profit. We haven't been given operating profit, but we have been given the operating profit margin. So if we are able to calculate operating expenses, we can use that to calculate operating profit because you've been given this operating profit margin. If you had sales, you could also perform this calculation using sales. You take the rand value of sales and you multiply by 30%, and that would give you operating profit. However, we don't have the rand value of sales, so we are forced to perform this calculation using operating expenses. We haven't been given operating expenses. Instead, we've been given total expenses. But in note 1, you have been told what those total expenses include. So what we need to do is we need to exclude any expenses that are not operating in nature, because we only want operating expenses. So let's just go through what these expenses include. They include depreciation of 36 million rand. That's fine. Depreciation is an operating expense, so we don't need to exclude that. It also includes interest expense of 17 million rand. Guys, interest expense is not an operating expense. It's a financing expense. So we would need to exclude interest expense from the total expenses of 3 million rand because we are trying to calculate operating expenses. Total expenses also include allocated head office costs amounting to 45 million rand. Now, these head office costs would need to be excluded because they are allocated costs from head office and they are not under the divisional manager's control. In addition to that, you have been specifically told that this operating profit margin has been calculated excluding allocated head office costs. So if the operating profit margin has been calculated excluding allocated head office costs, then these operating expenses over here must also exclude allocated head office costs. So that definitely needs to be excluded. Then total expenses also include research and development costs of 60 million rand. Research and development costs will be an operating expense, so we don't need to exclude that from the calculation when we are trying to calculate operating profit. We'll deal with the research and development costs when we get to making all of our adjustments. Remember, for now, we are just trying to calculate net operating profit after tax. We'll look at all of the adjustments relating to EVA separately after we've calculated net operating profit after tax. All right, so let's have a look at this calculation. We're going to start with total expenses, which are 300 million rand. We need to exclude the interest expense because that is not an operating expense, it's a finance expense. And we also need to exclude the allocated head office costs. Because those costs will not be under the divisional manager's control, and also the operating profit margin percentage does not include allocated head office costs. So that will then give us our operating expenses, excluding allocated head office costs. Now that we have operating expenses, we can calculate operating profit. Remember, the maths logic is you multiply by what you want and you divide by what you've got. So what do we want? We are trying to calculate operating profit. So we are going to multiply by 30. That's what we want. What have we got? We've calculated operating expenses. So what we've got is 70%. So we need to take the operating expenses and multiply by 30 over 70, and that will give us operating profit. Then be careful, we need net operating profit after tax. So we need to take the operating profit that we've calculated over here and we need to deduct tax. If you go back to the information provided in the scenario, in the additional information, you were told that the tax rate is 28%. So we can then just deduct tax at 28%. And that will give us net operating profit after tax. All right, so we've calculated net operating profit after tax. We now need to process various adjustments because remember, EVA adjusts for accounting distortions. So first what we need to do is add back accounting depreciation and instead deduct economic depreciation. Now, if we go back to the information provided, you were specifically told that accounting depreciation is considered appropriate to reflect the economic value of assets. So in other words, they are telling you that the economic depreciation equals the accounting depreciation. So we don't need to make an adjustment, because remember, when this operating profit over here was calculated, depreciation was not excluded because it's an operating expense. So we would have deducted depreciation when calculating net operating profit after tax. And because the economic depreciation is the same as the accounting depreciation, we don't need to process an adjustment. It's the same as actually deducting the economic depreciation. However, don't just leave it out. Show the examiner that you have considered this. Just in case there is a mark available on the mark plan. Then next, if there are any expenses that create a long-term benefit for the company, those expenses shouldn't be expensed in full in the period that they are incurred. Instead, those expenses should be capitalized and they should be written off over the period that the benefits are expected to be received. So in this question, we had research and development costs, and we were told that the research and development costs relate to the development of a new product, and the development expenditure did not meet the recognition criteria in terms of IAS 38. So we said, remember, that means they were not allowed to recognize the development expenditure as an asset, but instead the amount has been expensed. So included in our operating expenses, we have these research and development costs of 60 million rand. And you are told that the expenditure is expected to generate profits in the current and the next 2 financial years. So in terms of EVA, the full amount should not be expensed in this year. We shouldn't be expensing the full 60 million in this year, because the benefit is expected to be received this year and for the next 2 financial years. So instead, this amount should be capitalized and should be written off over the period that they expect to receive the benefit. So the research and development expenses would have been deducted when calculating net operating profit after tax. So we now need to add those expenses back. Because this cost is going to be capitalized, and then it's going to be written off over the period that they expect to receive the benefits. So they had part of the benefit in the current year, and they'll have benefits for the next 2 financial years as well. So this is going to be written off over a period of 3 years, and 1 year should be written off in the current year. So 20 million is written off this year, another 20 million will be written off next year, and the final 20 million will be written off in the following year. All right, then next what we need to do is consider if there are any non-cash expenses. So for example, if there's any movement in provision for bad debts, if there's any movement in deferred tax, etc., all of those things need to be eliminated, because what we are trying to do is convert accounting profit into cash flows. However, we weren't given any additional information, so we don't have any other adjustments that we need to process over here. So this is going to give us our adjusted net operating profit after tax. All right, and we can then include that in our calculation above. Then next we need to calculate the adjusted capital employed. And we calculate capital employed by taking total assets and deducting current liabilities. So we were given non-current assets at book value And in note 2, we were given the replacement cost of those non-current assets. Please remember, guys, where possible, you should use replacement values or market values of assets instead of historical cost. So we won't use the book value over here in the calculation. Instead, we'll use the replacement cost of 560 million rand. So that deals with the non-current assets. We then have non-current liabilities. Non-current liabilities are not included in the calculation. We need to add current assets so that we get total assets. We want total assets. So we take non-current assets plus current assets, and we then need to deduct the current liabilities. So we'll take both of those amounts over there into account in our calculation. All right, so non-current assets at the replacement value of 560 million rand. Non-current liabilities will not be included in the calculation. I'm just including this for completeness sake. The reason why the non-current liabilities are not included in the calculation is long-term liabilities are usually arranged by head office and they are not under the control of the divisional manager. So that's why they are not included over here. They are not controllable. All right. We then take the current assets into account. And current assets are 68 million rand. And current liabilities is 44 million rand. All right, so that gives us capital employed. It's your total assets minus current liabilities. Then, guys, we need to consider the adjustments that we made to net operating profit after tax. You'll remember we added back the research and development costs over here because we said those are going to be capitalized and expensed over the period that we expect to receive the benefit. So if we are going to be capitalizing the research and development cost and treating it as an asset, then we obviously need to include it in the calculation of capital employed. All right, so the total research and development cost was 60 million rand. However, 20 million has been expensed in the current year. So the asset should be sitting at 40 million rand. 20 million of that will be expensed next year, and the final 20 million will be expensed in the following year. So the asset should have a value of 40 million rand. All right, so that will then give us our adjusted capital employed. And we can then include that in our calculation above. Then finally, we just need to multiply that by the divisional WACC. And we were given the divisional WACC for the biscuit division. The adjusted weighted average cost of capital for the biscuit division is 12%. All right, so this is going to give us a positive EVA of 38.56 million rand. And then make sure that you actually answer the required. Did the manager of the biscuit division create value in the current financial year? Yes, because we have a positive EVA. So make sure that you conclude. right, then there's just one more thing that I quickly want to discuss with you. I took operating profit and I multiplied that by 28% to get the tax that is paid in order to get net operating profit after tax. Now, please note the only reason why I could perform the calculation in that way is because you were specifically told that the tax authorities were in line with accounting in terms of allowances. So that means for depreciation, the wear and tear allowed by the tax authorities, or in other words, allowed by SARS, is the same as the accounting depreciation. So that means the accounting depreciation that was taken into account when calculating operating profit is the same as your capital allowances or your wear and tear that SARS allows. In addition to that, the research and development costs that were expensed when calculating this operating profit would also be exactly the same as the allowance that SARS would allow. So because of that, we could just take that operating profit and multiply by 28% to get the tax amount. All right, I just wanted to clarify that in case anyone had any questions over there. All right, guys, so that then answers part E of the required.